It's easy to come up with a list of sanctions. The question is, can you think not just one move ahead, but two moves ahead, three moves ahead? What's the reaction function? How does it actually, what's the blowback? Does it end up hurting you more than it does the enemy, in this case, Russia? And the answer is often yes. And the reason is fairly straightforward, which is, we spent 30 years getting a densely interconnected, globalized economy. How on earth do you think you can blow up one part of it and not affect all the other parts? Of course it does. And there are many, many examples, but the most, well, just to recite some facts, not opinions, but facts. Russia's oil and natural gas revenues are at all-time highs. Any oil that Europe doesn't want for whatever reason, the Chinese and the Indians are happy to buy it, and they are buying it. They say, well, we're gonna call Lloyd's of London and tell them they're not allowed to insure Russian vessels. Well, it sounds effective. Gee, how are you going to ship the oil if you can't get insurance on the vessel? I guess they've never heard of captive insurance companies or what's called self-insurance. I mean, this goes back to the Merchant of Venice, Shakespeare in the 16th century, which is you get a group together, you got 20 vessels, you all take a slice of your revenue, you put it in a pool, you say, we hope for the best, but if one of those vessels is seized or sinks, then we pay for it out of the pool. That's called self-insurance. And that's what people did before insurance companies were invented. So my point being, these things sound good. They have a feel-good aspect to them, but they're tried and true workarounds, or they don't work the way people expect. So Russia's oil and gas revenues are at an all-time high. They've got willing buyers in China and India and elsewhere. By the way, a very long list of countries are neutral on this. US and EU and UK and Canada, Australia, Japan. Okay, that's a pretty powerful bloc, I get it. But look at the major economies that have stayed on the sidelines. So, India, Brazil, Saudi Arabia, Turkey, et cetera. There's the BRICS and Shanghai Cooperation Organization members in Central Asia, a lot of very, China. So a lot of very powerful economies are not playing along with this. The ruble is it's almost too strong. I mean, our friend Elvira Nabiullina, the head of the Central Bank of Russia, she may be looking to cut interest rates. In fact, she already has to some extent, to kind of weaken the ruble because it's too strong. It's not only stronger than it was before the war began. It was about 80 to 1. The war began. It had a little quick dip to 140, then came back to 80. But then it went to like 70 and 65. That's a very strong ruble relative to recent years. So again, that helps them get around the boycott because the ruble goes further if you're trying to buy imported goods. And again, many other examples. So reserves are up, hard currency reserves are up, oil, gas sales are up, the ruble is stronger. And meanwhile, what's going on in the West? In the US, $5 a gallon for gasoline. I know that seems cheap to Europeans, but trust me, for Americans, that's unheard of. Well, it is, it's a record high. We were a net exporter of oil. Now we're an importer at high prices. Everyone knew that we were drawing down our Strategic Petroleum Reserve, the SPD, in theory to mitigate gas price increases in the United States. Well, not enough oil. Here's some oil. We'll take it out of the Strategic Reserve. Well, number one, the problem was never oil. It's refining capacity. You have to turn the oil into refined products, whether it's gasoline, diesel, or kerosene, which is jet fuel. And the bottleneck is at the refineries, not at the oil, number one. Number two, that Strategic Petroleum Reserve is not, why don't we just pump some? Why are we taking our national security reserve and selling that? Why don't we just pump more oil, which we're entirely capable of doing? Well, that gets into the Green New Scam and all of that, the ideology and the politics of it. But just to make it worse, as if that's not bad enough, there's good evidence that some of those cargoes are going to China. We're not even using our own oil, even though we're diminishing our national security in the process. We're selling it to the main enemy. It's so bad. The policy is so bad that I think I'm a little late to this one. A lot of people reached this conclusion earlier. I was resisting it, but I have to say, stupidity is no longer an explanation. This must be what they want. It's so, if you were just stupid, if you were just dumb, you would be right about half the time. You would be guessing, you wouldn't know what you're doing, but just random outcomes, you would be right about half the time if you were really dumb. To be wrong all the time suggests design. It suggests that this is actually what they want. The greenies want higher gasoline prices because they think it will encourage, discourage gasoline consumption, encourage the purchase of electronic vehicles, EVs, Teslas and so forth. So people who can barely afford a $30,000 car are supposed to go buy a $75,000 car. The inflation is coming from the supply side. It can come from supply or demand. The supply side means energy, food, transportation costs, and a lot else besides, and then also taking into account the breakdown of the supply chain, which we mentioned earlier. Demand-driven inflation comes from the consumer, it comes from the psychology. Do people feel the prices are going up? And if they do they start to change their behavior and pull demand forward? That's why they call it demand pull inflation, and say, I was thinking about buying a refrigerator. I better go buy it today because the price is going to go up if I wait another month, et cetera. Both of those can be sources of inflation. They can feed on each other. Right now, the inflation is all coming from the supply side. We have not tipped over. So what can the Fed do about the supply side? Well, they don't drill for oil. They don't drive trucks. They can't farm for crops or run a textile mill. The Fed can't do anything about the supply chain or the supply of goods and services. The one thing they can do is raise interest rates enough to destroy demand, not just tamper it, but really destroy it to the point where, hey, maybe I don't like paying a lot for gas, but if I get fired from a job, I might not be buying gas at all, or just cutting down on driving, or eating cheap substitutes for better quality food, et cetera, or some people starving. So can the Fed control inflation at the end of the day? The answer is yes, but at an extremely high cost. It's not a question of pivoting to interest rate cuts next January. That's the narrative. It's just not true. If interest rates go down, it'll be because we're in a very severe recession. And of course, the Fed will be the last to know. So the Fed can temper inflation, but at a very high cost, the cost of a very severe recession. The good news is prices are down or flat. The bad news is you just lost your job. And why is that good for stocks? I guess that's my question. So the answer is it's not. But if you live in a world where we have very strong inflation today, but we could be facing disinflation, almost certainly, and possible deflation, how do you structure that portfolio? Because if I could guarantee inflation for a couple of years, that's easy. Buy gold, real estate, fine arts, silver, energy, agricultural, hard assets. If I could guarantee deflation, that's also easy. You want cash, government bonds, a few other assets that are going to perform well in a deflationary environment. But what if I said, and I am saying, we have inflation now, but we could flip to deflation, but it's hard to know exactly when. How do you position for that? And the answer is diversification. You have a slice of gold, I recommend 10%, slice of cash, which not only protects you in deflation, but gives you liquidity, reduces the volatility, and gives you optionality. So when we get more clarity, you can actually go, maybe shopping among the ruins of the stock market. It's a place for stocks, but I would lean towards energy and the agricultural sector and other natural resources, and alternative investments, and certainly real estate and government bonds, which do very well in a dropping interest rate environment, which we're already in. The short-term rates are still going up because of the Fed, but intermediate to long-term rates are coming down. And, if you have 10-year treasury notes, you could get very significant capital gains if the yield maturity on the 10-year note drops from, let's say, 3% to 1.8%, which is where it was not that long ago. As far as gold mining is concerned, are there supply chain issues? Yes, but that should actually help the price of gold. In other words, if you think of supply and demand, demand is what it is. It has its own drivers, including real interest rates, fear factor and inflation and other factors. But if the supply is constrained by the supply chain, then that's actually bullish for the price of gold. As far as miners are concerned, there's no such thing as a generic miner. I don't think of miners plural. You have to take it company by company, and you have to ask yourself, look, geology is what it is, engineering is what it is, cost of capital is what it is. Those things tend not to vary that much. The biggest variable, the thing that will separate a successful miner from one not so successful, is the management. You need to look at the CEO, the chief geologist, the CFO, look at their resumes, ask yourself, have they done this before? Is this their first, are they beyond the exploratory stage? Are they into the production stage? Are they a possible takeover candidate for Barrick or Newmont or IAMGOLD or one of the big guys? They don't actually do that much exploration. What they do is they just buy successful early stage or mid stage production companies. And so that being the case, there are a couple of ways to make money in gold mining. One is if the price of gold goes up, well, that'll take the stock up. Two, if they have more gold than they thought, they had a certain estimate. It turns out they have much bigger veins, and that's good. But the third way to make money, a takeover premium. Somebody comes along and buys them and pays more than the market value for the shares to do an acquisition. So there's some very attractive opportunities, but you just have to be selective and focus on management, because that usually is the determinative factor between a success and failure.